Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. Let's talk the macro picture as we lead you up to the opening bell. Joining us for that is Ahmed Riesgo, Chief Investment Officer at Insignio. Ahmed, thanks so much for joining us on this Friday.
Thank you. Good morning to you.
So I want to get your thoughts on that PCE data we got this morning. Does the inline reading for core PCE, the uptick in personal spending, change anything in your mind about fight against inflation or the Fed?
No, it really doesn't. I mean, they were slightly hotter on the headline number, but really not too far off. I think really the most important development over the last several weeks for the Fed has been the upswing in the 10-year yield. Remember, that's the most important rate for the economy. It's the economy by which, or it's the rate by which mortgage rates are set. And so that increase in the yield on the longer end of the U.S. Treasury curve has really done a lot of the Fed's work for it, which is really going to preclude, we think, the Fed from hiking any further. Now, the question of how long they remain there, that's still an open question. But I really see no reason for the Fed to have to raise rates because, like I said, the market has done the Fed's work for it.
You know, when you talk about the upswing in the 10-year yields, is 5% the peak for yields, or do you think they ultimately move higher from here?
Look, it's very tough to call peaks and bottoms, as you well know. All I can tell you is that the yield is above where what we estimate to be fair value, which is in the low fours, which means that we would buy it. We would start adding duration at these levels. They could go higher for a bit, but we don't see it gravitating too much further from there.
And what do higher yields mean for the stock market then? Do you think that yields could continue to tick higher, but what does that mean for stocks?
Well, if yields do tick higher, it's going to be very tough for the market to rally here. Now, if they have a leg down, we do think there is a scope for the market to outperform here or to start sort of swing higher over the near term. But at some point, stocks are going to have to reckon what that actually means. And what it means is that the economy is slowing, because if the yield goes down, it's basically going to be due to that. So they're going to have to contend with the hit to earnings. And I think what we've seen with the preliminary numbers that have come in on the earnings season so far is that the economy is nowhere near as strong as that GDP number that we saw earlier in the week. Companies are presenting a much more downbeat view and expectations. So what we're seeing is an economy that, although it's still growing, it's quickly decelerating and nowhere near as strong as some of the economic prints we've seen here recently.
But the 4.9% is certainly not recessionary. And I was taking a look at your notes, and you say the recession, the onset of a recession is deferred, not averted. So that means you think a recession is still on the table.
We do. We don't think we're in a recession. We haven't had a recessionary call throughout the year, which was a bit of an out of consensus call back when we made it earlier in the year. That doesn't mean that we've averted it altogether, though. We do think that sometime in the middle of next year, we will get a recession. Ultimately, we think at this point, monetary policy is finally restrictive, and you're starting to see it reflect among companies, and you will soon start to see it reflect in the economic data, where you will see a downtick in that data. So remember monetary policy, the famous quote, long and variable lags. It's just really only recently till we've gotten to the point of restrictive policy. So that just means that that tightening that's happened, and that has happened recently with that upswing in yields. Remember, it's not just the Fed funds rate going up. That tightens monetary policy. But the long end of the curve going up, that also tightens financial conditions. That is going to lead to decreased economic activity to the point where we do expect a pretty mild recession towards the middle of next year.
Okay, so the Fed likely or almost guaranteed to hold rates steady next week. Sounds like you think the Fed's done hiking overall, but do the rate cuts come because of an economy in recession in the middle of next year?
Yeah, a lot of that is going to depend on the employment market, the labor market. The Fed won't feel any reason to start cutting rates unless there is an upswing in the unemployment rate. So until we get that, until we get a breakdown in the labor market, the Fed will stand perfectly pat here. They're comfortable here. I do want to say one thing. I think, it's pretty clear that the Fed made a mistake earlier in this cycle in beginning the rate hiking cycle too late. I don't think they're going to be wrong in the same direction again, which means that if they are going to be wrong, what it means is that they're going to over tighten and they're going to lean in that direction. I think at this point they've done a really good job in containing long-term inflation expectations. They're not going to stop short of making sure that that's under control. So the Fed will risk a recession in order to bring inflation under control and keep those long-term inflation rates or inflation expectation rates anchored.
This is a market that seems to really believe in the soft landing scenario at this point. So what does pricing in a recession look like in terms of stock market performance?
Yeah, so I'd like to point out, the market is pricing in a bit of a soft landing scenario. It's literally never happened. So we're not betting that it's going to happen this time. What we are expecting is that the market to pretty much remain choppy throughout the end of the year and then to go down during the first half of the year. But then we do expect a rebound in the second half of the year once the Fed is actually able to start cutting rates in what is ultimately a mild recessionary environment. Like I said, we don't expect a strong recession in the United States. In some sectors, it won't even feel like a recession. Take tech, for example. Tech already had their recession. They already cut jobs. You saw that report today from Amazon. Their labor force is much shrunken. So tech already went through their recession. Some sectors won't even feel like they're in one. So pretty mild recession scenario. We think that will allow stocks to rally into the back half of next year.
So Ahmed, where are you comfortable putting money to work right now, anticipating choppiness through year end and then a potentially lower market through the first half of next year?
Yeah, I think it's like what I mentioned earlier, into long duration plays. I think I find the 10-year attractive here at these levels. So I think this is a good place for investors to tactically add duration risk. We also are seeing opportunities elsewhere. For example, emerging market local currency debt looks pretty attractive in many markets. Markets like Mexico is one example. So there are opportunities globally out there.
What about in terms of U.S. equities? Would you be more likely to buy tech or energy right now?
So we're focused on quality. Because quality as a factor, it's really emphasizing two parts. It's, high return on equity and companies that have low debt and low leverage ratios. And because we do think we're in a high interest rate environment, but we think we will remain in one for quite an extended period of time, those companies tend to perform better in that type of environment. So you want to focus on companies that have high factor exposure to quality, which means they have high return on equity and low leverage, low debt. Consequently, part of the tech sector definitely has a high factor exposure to quality. Names like, Microsoft, Amazon, those types of names have high factor exposure to quality.
And then just out of curiosity, in terms of catalysts that will ultimately move this market or potentially keep it choppy, between now and year end, what will the key catalysts be in terms of moving this market?
Yeah, well, I think it's going to be a combination of obviously Fed policy and the evolution of the market's view of Fed policy, but also the geopolitical risk. One of the reasons why I'm not sort of trusting the rally today, so to speak, that we're seeing here in the futures is because I do think traders, especially the more nimble investors out there like traders, will want to lighten exposure going into the weekend because there's simply too much uncertainty on the geopolitical front. So I think as long as there is this ongoing conflict between Hamas and Israel, which is ultimately not that important for markets. Obviously, there's an important human component to it, and I don't want to minimize that. But for the overall global economy, it doesn't really matter too much because neither Israel nor the Palestinian territories are oil producers or are near any important transitory points for oil. It really doesn't matter. What the market is concerned about is any impact that it could have on the global oil supply if this conflict were to expand beyond the two combatants.
It's interesting because oil prices are higher today. They're up about 1.5%, but still below $85 a barrel. Are you surprised we haven't seen more of an uptick in oil prices given geopolitical risk and given the fact that the economy is stronger than many were expecting at this point?
Yeah, so I think at this point, the sort of oil supply demand dynamics are pretty well balanced right now. The market knows that Saudi Arabia could ramp up production if they have to. And I think the market is correctly assuming here that neither Iran nor the United States wants this conflict escalated. And those are really the two principal geopolitical actors that are necessary here in order to keep that oil price down, because they're really the only two that could force a major disruption in global supplies.
Ahmed Riesgo, Chief Investment Officer of Insignio. Certainly we're able to discuss a lot. Thanks so much for your insights. Really appreciate it.
Thank you.